banks are in control of your money. Therefore, they send your money out to work for them. And when that money's working for them, they're making a spread because that's what banks do. What's going on, everybody? I'm Chris Naugle, and welcome to the Money School Podcast, episode 250 something. I don't know what number this is, but 250 was a monumental number. So we're after that now. But today, what we're going to do is we're going to talk about what is the infinite banking concept. You may have heard about this, but this is what I do. And one of the interesting things is when I'm out to dinner or I'm in an elevator or I'm with a group of people that I don't know, they always ask you, so what do you do? And my answer is always simple. I'd say I help people take back control of their money by teaching them how to be the bank. Wow. Well, what is that? Well, it's a thing called the infinite banking concept. And that is what we're going to talk about today. But I'm going to break it down in some very simple steps for all of you, because I think that's the most important thing. Let's just say you were stuck in an elevator with some people, or you're just at a family outing or a family dinner, and they say, so what is this be your own bank thing? What would you say? Well, I know what a lot of people would say, but I'm going to show you exactly how you articulate this. And we'll do the long version and then you can shorten it up, but it's quite simple. All of us work and make money, right? That's just part of what we do. This that I'm holding in my hand, we call this money. Some people call it the dollar. Some people call this a means of exchange, which would be the proper definition of money. It's nothing more than a means of exchange. If you have something I want to buy, I exchange money and you exchange the goods. Let's just say I'm buying a pair of glasses. Well, these glasses weren't free. I had to exchange money for those glasses. And in that exchange, I had to have the money first. So how did I get the money? Well, there's a couple different ways you get money. You work for it. You trade hours for dollars. Okay. Then also there is money from investing, your money working for you. I like that. And then also there's things like inheritance that you could get. And there's many other ways you can get money, but you get the drift. You get money. Now let's talk about the next thing you do when you get money, because there are 4 things you can do with the money. Number 1, some of you save money. You make it and you're like, all right, I'm going to save that. And hopefully that is 10% of your income, because that is law number 1, save 10% of what you make. So you can save money. What else can you do with money? Well, I just told you, you can spend it. You can say, all right, here you go. You can exchange it for things you need, like glasses, like cell phones. You could even go on Amazon and buy my book, Mapping Out the Millionaire Mystery. You could exchange money for all sorts of things. What else could you do with money? Well, you could give it away. Yes, you could. You could certainly give it away. You could be charitable in your money. So we could save it. We could spend it. We could give it away. And what else can you do with it? Well, I'll leave that up to your imagination, but let's just now discuss what happens when you do those things we just said. Well, focus on just the savings. If you save money, you're giving up control of that money in most cases, right? Because if you give that money to a bank, you just gave up control of your money to the bank. And the bank gets to use that money for anything they want to do. The bank can go out there and lend this to your neighbor to buy a new car. They could lend this to another neighbor for a home equity line of credit. They could lend your money out to anyone for any reason they want, and you have nothing you can say about it. You ever wonder about that? And what do you get in return for giving up control of your money? Well, they pay you interest, right? Oh, they don't? Your bank isn't paying you interest? Well, time to find a new bank. Banks pay you interest, right? And the amount they pay you in interest, what is it right now? It's a little less than 1% to probably a max of 5% from what I'm hearing on the street. This is February 2024. So you get interest on your money and you're pretty happy about that. But when you go back to the bank and you petition them, or you beg them in some cases for a loan, do they charge you less than what they pay you? Oh, no, no, no. They, in fact, charge you more interest than what they're paying you. So if they pay you 5, are they lending you money at 5? Nope. How about 6? Probably not. It's probably more like 7, 8, or 9% if they're paying you 5. And what is in the middle of that? It's a magic word. And I want you to just think of this magic word called spread. That's right. They are making a spread. It's the interest they pay you, 5%, minus the interest they charge you, 10. They make a 5-point spread, or 4-point, or 3-point. You get the drift. Banks are in control of your money. Therefore, they send your money out to work for them. And when that money's working for them, they're making a spread, because that's what banks do. Now, I told you I would tell you what the infinite banking concept is. Here's the definition. The infinite banking concept is you taking back the banking functions in your life. So I just told you how a bank operates. So what we now have to do is take back the banking functions in our life. And to take back the banking functions in our life, we must take back control of our money. Remember earlier, I said, when people ask me, what do? I teach people how to take back control of their money by showing them how to be the bank, using a concept, a process called the infinite banking concepts. And what is the infinite banking concept? The process of taking back the banking functions in your life. So in order to do that, we must first change one thing. Very simply, change one thing. And that is where our savings goes first. Because if we put it into the bank, well, we already know we gave up control, and they're the ones going to make the money in the spread. But if we put it into a 401k, well, we got all sorts of other issues, like we don't have liquidity, we don't have access without penalties. That money's going to only be available to be invested into whatever things they tell us they want us to invest in. You don't just get to pick from the universe of investments in your 401k, do you? So you don't have control. So we must figure out, where can we put this money where we are in full control of it? Well, to figure that out, all you have to do is look back in history. And it's not hard to find. You look back to the wealthiest families in history. And also, if you want to really see the history of the infinite banking concept, I made a great video on my YouTube channel. So let's pause real quick. Shameless plug. Go to YouTube and punch in the Chris Naugle. That's right. And make sure when you go there, you subscribe. Hook a brother up a little bit. I'm doing this for free. There's no advertisements on this podcast. So check out my YouTube channel, subscribe to it, and click that little bell, smash that bell, so you're notified every time I put new content out. You get to benefit from that. So that's my shameless plug. Let's get back to the infinite banking concept. And then hopefully by now you will have watched that history of the infinite banking concept. But families like the Rockefellers, the Rothschilds, the Morgans and Stanleys, you'll kind of notice one familiarity with all of those is they were all bankers in one way or the other. I mean, definitely the Morgans and Stanleys. The Rockefellers, you would say, no, they were in oil, but yeah, they still ran a banking system, but it was a family banking system. The Rockefeller family banking system. And the Rothschilds, very similar, were also bankers if you look back in history. So they're all bankers. But what did they all figure out? Well, they all figured out that their money, when put into a bank, was not in their control. And also they figured out the money, when it was put into a bank back then, was not really that safe. Because if there was a run on the bank and the bank went bankrupt, well, they didn't get their money back. So they were seeking a safer place to put their capital, and a safer place that then they controlled their money. So where did they figure out that that place would be? Well, it wasn't a bank. It wasn't Wall Street. It wasn't some fictitious thing. It was an old institution that all of you know about. All of you have probably given money to, and all of you absolutely have used in one capacity or the other. And that is called the insurance industry, specifically the life insurance industry, because they are in the business of providing guarantees. They are in the business of providing guaranteed death benefits. But what you don't know is they're also in the business of paying uninterrupted compounding interest. And because they're an insurance company and they can make guarantees via contracts and live up to them because they've been around for hundreds of years, well, that's where the wealthiest families in history landed. And they also landed there because they figured out and knew to be fact that insurance companies were the strongest and most stable financial institutions of the time. And that is still true today. So all they had to do is take all their money, gather it all up. Yep, got it. Got all my money. All right. And I just got to find an insurance company. Where's life insurance? Oh, that's a life insurance company. Walk in the front door and be like, excuse me. Where can I deposit this money? Anyone know? Where's the deposit line? Is there any tellers maybe over there? No? What do you mean? What do you mean I can't deposit money here? Well, I know you're not a bank, you're an insurance company, but somebody said that I could come in here and create my own banking system at this insurance company. I mean, come on, who here can take my money? No one. And why is that? As I get rid of this little buzzer, well, that's because they're not a deposit institution. So you see, these wealthiest families had to overcome. How do they find a way to put their money in the insurance companies and take advantage of all that safety, security, that control of their money, and the guaranteed interest that insurance company was willing to pay them? And they figured it out. They figured out, well, guys, we got to use mutually owned insurance companies because to be in control of our money, we must be an owner of the insurance company. So we cannot use publicly traded insurance companies. No. We must use mutually owned, keyword, mutually owned insurance companies. And we must find a way to take ownership or a portion of ownership of that mutually owned insurance company. And here's how they did it. Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up. They did it through a product that all of you know about, all of you have used, and all of you may like or dislike, I don't know, but it is called a whole life insurance policy. So what they did is they found a way to put their money into the insurance companies through a product called a whole life policy, but they designed and engineered the contract. And they did that so that a large portion of their money just went to the insurance company's general account, in which they received a very nice guaranteed interest rate for the rest of their life that never changed. And because the company was mutually owned and because they were technically an owner through a policy, so they were a policy holder, which makes them kind of like an owner, they then got to partake in dividends. So when the insurance company doesn't use all the premiums that they account for or that they take in every year, they return those unused premium payments to the policy holders, the owners, via dividends. So these wealthy families, and you as well, probably want to take advantage of those dividends as well, because guaranteed interest plus a dividend is definitely not such a bad thing. So that's what the wealthiest families did. Back to the infinite banking concept. So now what did we do? We determined that we had to change one thing, and that was where our money went. We decided that that money was going to go into a specially designed and engineered whole life insurance policy through a mutually owned company that pays dividends. Mutually owned life insurance company that pays dividends. Now, how do we take back the banking functions in our life? Now that we've got our savings over here, we're going to call that capitalization. We, through premium deposits, have capitalized our banking system. No different than the Rockefellers, Rothschilds, the Morgan Stanleys, Walt Disney, Ray Kroc, Pampered Chef, Doris Christopher, all of these folks and did the same exact thing. They capitalized their banking system by funding, through premium deposits, a whole life insurance policy. Now, the next step is we must then think like a bank and act like a bank. So now we've got a banking system. You might just say, no, you don't. You've just got a whole life policy. Think as if I have a banking system because I am in full control of that money. You see, now today, if I want that money or I want a portion of that money that I just deposited, I can take it out anytime I want, immediately in the first 30 days when my check clears. And I'm not going to just take it out as a withdrawal, although I could. But if I take a withdrawal, my money leaves the account and now I'm earning interest and dividends on a lower amount. But see, in the policy, I am allowed to take loans anytime without any questions. So all I'm going to do is act like a bank. If I owned a bank and I wanted money from my bank, what would I do? I would take loans from my bank. Of course I would, because that's just what you do from banks. You borrow money and take loans from everybody else's bank. So if you owned a bank, of course, you would never take a loan from somebody else's bank. You would take a loan from your bank. Think as if you are the bank. So now I'm going to take a loan from my bank, the policy. And the insurance company allows this. But you see, the insurance company not only allows this, the insurance company allows us to take this money without any of those burdensome loan applications. We just take the money. The insurance company will give it to us because the insurance company knows that someday they're going to have to pay a death benefit to our beneficiaries, guaranteed. So all they're doing is they're advancing us part of our death benefit while we're living, up to the amount of cash value that we have in the policy, because the cash value must collateralize the loan against the death benefit. Does that make sense? So just like any other bank, the loan we're taking must be collateralized, and it's going to be collateralized by the amount of premium deposits plus interest and dividends compounded in your account, which goes up every single day. Because in the whole life policy, your money can never go down. It can only go up. It can only grow. It can never do anything other than that because it's compounding at a guaranteed interest rate. And then if you get a dividend, now you got a dividend that's compounding. Do you see how this works? It can't do anything but go up. Very different than your 401k, very different than the stock market. So now we've got this loan. And also, just so you all know, this is Lazy Cash, our shop cat, who just showed up for this episode of the podcast. He's always a little bit late, but that's okay. He's just going to sit here and be lazy. So back to infinite banking concept. I've got a loan. What am I going to do with this? Well, you're going to do the same thing a bank would do. You're going to find a way to make this money go to work for you. Now, what are the ways you can do this? Well, there's lots of different ways. You could buy a car, you could buy a house, you could invest in real estate, you could buy stocks, you could buy Bitcoin, you could pay off debt. I always like to start there because the fastest way to build your wealth is through your own debts and expenses. So let's just assume you have some debt. So if I take that loan I just took from the policy, which was an advance of my death benefit collateralized by the cash value, and I then take that loan and I pay off my debts or some of my debts, I now no longer have to make payments to those paid off debts, which those payments used to go to somebody else's bank. Remember, I'm trying to be the bank. I'm trying to take back the banking functions in my life, which means I no longer want to give up the banking functions and make payments to somebody else's bank. However, I do want to make payments back to my bank because if I'm going to be the bank, I must act as if I am the bank. I must treat my money the same way I treated somebody else's bank. So because I paid the credit cards and the debts off with a loan from my bank, I no longer owe their bank monthly payments. So now what I'm going to do is I'm going to take those monthly payments I used to make to their bank, and I'm going to then make those payments back to my bank. When I make the payments back to my bank, do I have access to that money? So let's just say those payments were $500 and now I'm making $500 payments back to my bank as a loan repayment because I want to repay the loan, essentially fill my death benefit back up. That $500 or that loan repayment I just put back in my policy, I have full access to it. Now, see, it doesn't work that way when you do it to somebody else's debt, but when you own the bank and you are the bank, when you put money back in the policy as a loan repayment, you immediately have access to that money. So now, effectively, I have taken back the banking functions in my life on those credit cards. Now, something else happened there. All of you have probably seen the game Monopoly or even played it. It's a square with a whole bunch of little spots that you can go past. There's jail, there's all sorts of things. And there's also the go section, which when you pass go, what happens? What happens when you pass go? You get $200, right? I want you to think of go being your policy anniversary. So every 12 months, we're going to go around the Monopoly board and we're going to pass go every time. And every time we pass go, what do we get? A dividend. I already explained that. So as that dividend accumulates, as the interest accumulates, as we keep saving more money through premium deposits into our policy, we accumulate and capitalize our banking system. So now every time we go around the board, we get to start investing that money by buying properties. And we start buying properties around the Monopoly board, building rentals, Airbnbs, whatever. Maybe we even just lend some money. Eventually, everybody wants Boardwalk and Park Place. Why? Because they're the most expensive and they pay the most rent. So now each one of those little squares on that Monopoly board represents an opportunity. Earlier, I showed you the first opportunity, taking back the banking functions in your life by repaying your debt, which is the fastest way to wealth because you're giving money away to somebody else's bank. We want to take that back. But now when all your debts are paid off, we're going to invest that money in things you know, like, and understand. And investing can also, now that you own a bank, investing can also be things like, I'm just going to buy a car. When you buy a car, you take a loan from your policy. Okay, we got the loan, which is an advancement of our death benefit from the insurance company's general account, collateralized by our cash value, which is a combination of our premium deposits, our loan repayments from those credit cards now that are recaptured back in, plus uninterrupted compounding interest of our interest and dividends. We took that loan back out. Now we're going to go buy a car. We pay cash for the car. But the cash we paid for the car was a loan from our bank. So what are we going to do? Well, we're going to determine the terms we want to repay our bank back. You are in control of your money. Therefore, you're in control of the terms. So you buy a car. How I do it is I just figure out what another bank would have charged me for financing a car that I want to buy. Now, instead of them financing it, once they tell me what the monthly payment's going to be and the interest rate, the best interest rate, I then just mimic what their bank would have done and I pay my bank back the same amount. So let's say the payment on that car would be $1,000 a month. I'm just going to pay my bank back $1,000 every month. I'm going to set a bill pay up and I'm going to take that $1,000 a month and I'm going to put it back in my policy as a loan repayment, effectively taking back the banking functions because I'm no longer leaking the $1,000 a month, which I normally would have given to some car finance company or some bank that gave me the money for that car. I'm paying that $1,000 back to my banking system, which effectively took back the banking functions in my life. Do you see how this works? This just keeps going round and round. We just keep going around and around and around because we control the flow of our money. And we want our money to keep going around that circle. Because remember, like Monopoly, every time we cross the go, every time we pass go, we get $200. Every time we pass go, we get a dividend. And our dividend keeps going up because our cash value keeps going up. And we can control how fast it goes up by controlling the banking functions in our life. The last thing that maybe I didn't hit, and I always like to save this for last. When you take back the banking functions in your life, you have no more leakage. No money goes to anybody else's bank anymore. It all just comes back to your banking system, which creates another problem because now your banking system constantly has money that you need to find a place for that money to go to work. That money's always got to be deployed because banks don't sit on money in the vault just letting it sit there, right? Waiting for an opportunity. No, they find opportunities. And the money that they can't move, what do? They invest that money in treasury bonds. And what else do they invest their tier one capital in? Oh my goodness. BOLI. Bank-owned life insurance. Do you realize that traditional banks are the number one purchasers of whole life insurance in the world? It's called BOLI, B-O-L-I, bank-owned life insurance. Look it up, fdic.gov. Just type in BOLI. You will find that banks are the number one purchasers, and the top 5 banks in this country, just the top 5, have over $75 billion in BOLI. Anyway, I got off track, but isn't it funny how the banks themselves are using this as a place for them to store their capital? I just thought you'd get a kick out of that. But while we go around and around this circle, and while our money keeps building up through premium deposits, which is our savings, interest and dividends compounding, plus the recaptures from our money going out and working for us and taking back the banking functions, the one thing that didn't stop this entire time, and this single-handedly is why the wealthiest families use this, because our money never leaves our account. Our money never stops earning uninterrupted compounding interest on the full amount. regardless of whether or not that money's in the policy or out working in cars, debt repayments, and investments. We got to take back control of our money. But in doing that, we got to earn uninterrupted compounding interest, which also means that we got to make a spread on our money, just like the bank. Because if our money is compounding, when we take loans from the insurance company does charge us interest on those loans, but the interest on the loan is usually less. Actually, my entire career always been less than the amount I'm earning on my policy and interest and dividends. So if the interest and dividends, the declared dividend, okay, if that is 5.5 and I'm paying 5%, I'm making a spread. But my spread goes up every single year because if you understand mathematics, you would understand the difference between compounding interest and simple interest. You see, the interest charged on the loan is simple. The interest earned on my cash value is compounding. One is going up, one is going down. Because if I'm following that process, the infinite banking concepts, my loans are always being paid down by my money working for me. So as my loans are being paid down, my APR that I'm paying on those loans to the insurance company is declining while my cash value is compounding up. So therefore, by sheer mathematics, every year, you'll have more money than you did the year before. Every year, your spread will grow. And every year, you will have taken back the banking functions in your life and effectively taken back control of your money. So what is the infinite banking concepts? It is what I just explained, the process, not the product, the process of you taking back the banking functions in your life, which the product, that whole life policy, simply makes it work better because of uninterrupted compounding interest, security, liquidity, protection from judgments and liens, and a death benefit, which provides a legacy. And all of the interest and the dividends that compound in the policy grow tax-free as long as the policy is designed properly. If you want to learn more about this, what you can do is go to beyourownbank.com and you can watch a 90-minute video and book a call with one of our money mentors. Folks, I hope this helps you. I hope next time you're sitting down with your family or your broke-ass brother-in-law for Thanksgiving dinner and they ask you what you're doing and you say, well, I'm taking back control of my money by being the bank. Well, what does that mean? Well, it's called the infinite banking concepts, and what that is me taking back the banking functions in your life or in my life. Thanks for joining me for this episode of the Money School Podcast. I hope you now understand what the infinite banking concept is. We'll see you next time. Say bye, lazy cash.